Following our recent discussion on AIRO Group Holdings, Inc., today we're shifting gears to look at a real stalwart of American industry, Ducommun Incorporated. This is a company that's been around providing complex engineering and manufacturing, primarily in aerospace and defense, since, believe it or not, 1849. Now, Ducommun's really seen quite a transformation lately. I mean, look at the stock, up nearly 168% over the last 5 years. That doesn't just happen, right? It reflects a very deliberate strategy, moving towards more engineered, higher margin products. So the big question we're tackling today is this: does Ducommun's current, let's call it premium valuation, which is, clearly driven by the strong execution and the defense sector tailwinds, does it represent a sustainable investment? Or is the market maybe getting ahead of itself, asking a bit too much given the company's, let's face it, historically volatile performance and some ongoing risks in its business segments?
And I think that's exactly where the tension lies. Look, we have to give credit where it's due. The recent performance is impressive, no doubt. But the question really is, what's the price of entry? Is today's price justified? My argument is that, yes, management's pulled off a significant turnaround, but the current valuation feels, stretched. It seems quite high relative to what I'd consider its intrinsic value, and I believe the market isn't fully appreciating the historical operational baggage and the risks tied to relying so heavily on defense to sort of carry the whole company.
Right. Well, my position is pretty straightforward. I think Ducommun's current execution speaks for itself. You see it in their recent earnings beats. You see it in them hitting record margins. And they have a clear plan, this Vision 2027 strategy. It's all about focusing on higher value engineered products, leveraging that defense growth. They've specifically targeted, these high cost of failure applications in their structural and electronic system segments, covering defense, aerospace, industrial, even medical. And importantly, their balance sheet gives them room to maneuver. Liquidity is strong, quick ratio over 2, current ratio over 3, and debt, very manageable. Debt to equity is well under 0.5. So the market, I think, is rightly anticipating they'll keep executing. You can see that expectation baked into the forward numbers, like the estimated EPS of $4.51 for next year, which brings that forward PE down significantly. That, to me, validates the price appreciation we've seen.
But I'd really push back on the cost of that expected growth. We're looking at the TTM PE up there at 34.51. That's pretty rich, but even more telling, I think, is the PEG ratio. When you factor in the expected growth, the PEG is sitting at 2.08. Now, for anyone listening, a PEG over 1 is generally considered potentially expensive, and over 2, like this, well, it means you're paying more than double for each unit of expected growth. That screams expensive, even if next year's forecast is positive. And we absolutely have to put this recent success in context. Before this upswing, Ducommun had some really rough years. EPS declined significantly, down over 42% in the 3 years prior. So this current high valuation, it's really riding on a very, very recent wave.
But look, the market is a forward-looking mechanism, fundamentally. And yes, the TTM PE of 34.51 looks high in isolation, but getting too hung up on that is, it's looking in the rearview mirror, isn't it? The projection is for, 20.76% EPS growth next year? That's a powerful number. And it brings the forward PE down to around 20.22. Now that level, I'd argue, reflects a pretty reasonable premium for a company that's not just talking about a strategic pivot, but is actually doing it. And crucially, showing margin expansion while doing it. Gross margins are solid, over 25%. Operating margins over 8%. I mean, the market cap has grown, 350% since late 2016? That doesn't happen by accident. It feels like pretty clear validation of the current leadership strategy.
I understand the focus on forward momentum, I really do, but I'm just not sure it holds up when you look at the valuation multiples across the board. Yes, the forward PE comes down, but that PEG ratio of 2.08, that's still a major hurdle for me. Remember what Ducommun does. They make components. They operate in cyclical industries, aerospace, defense, industrial. Now, for a component manufacturer in those kinds of sectors, demanding a premium of over 2 times the expected growth, that implies absolutely zero room for error. And it's not just the PEG. Look at other multiples. EV/EBITDA is over 16. Price to free cash flow is way up there at 33.48. That high PFCF is particularly concerning, right? Because it suggests the price is quite stretched relative to the actual cash the business is generating. When you see high multiples like this pretty much everywhere you look, it tells me the market isn't just pricing in success, it's pricing in near-perfect execution of this Vision 2027 strategy for years to come. That's a high bar. And, speaking of execution, let's dig into the quality of that recent growth. Because, frankly, I'm not convinced the revenue growth itself justifies this kind of multiple. Sales year over year on a trailing basis is only up 2.42%. It's pretty modest growth for a stock carrying this valuation premium. And the recent earnings reports themselves explicitly say that the growth in the defense segment is offsetting weakness in commercial aerospace. That points to a pretty significant and persistent imbalance between their segments. You've got the electronic systems segment driving a lot of revenue, heavily leaning on defense contracts. So what happens if that defense cycle slows down? Or, just plateaus for a bit, which happens. The company's going to be pretty exposed to those ongoing challenges in commercial aerospace, challenges they specifically mentioned in their Q2 reports.
I think maybe you're framing resilience as vulnerability. Look, the strategy is designed to be diversified across A&D, industrial, and medical. The fact that they can post strong earnings and expand margins even with headwinds in the commercial sector, to me, that demonstrates effective operational control. It shows management can steer the ship and maintain profitability even when one part of the market is tough. And let's not forget the underlying stability Ducommun has. Around 95% of their revenue comes from U.S. operations. That provides a level of stability tied to, relatively predictable U.S. government spending cycles. That's a huge advantage compared to peers who might be more exposed to, say, volatile global commercial markets. And beyond just the operational side, look at who owns the stock. Institutional ownership is really high, around 88.5%. And the short float? Tiny, less than 2%. That signals pretty strong conviction from large, sophisticated investors, doesn't it? These institutions aren't just gambling. They're committing significant capital because they likely believe in the Vision 2027 plan and management's ability to execute. And this confidence is underpinned by the company's financial prudence. Look at their very low long-term debt levels.
But we can't just brush aside the risk profile tied to their past operational activities. You highlight the balance sheet metrics, which look good on paper, yes. But doesn't the history of litigation and operational issues represent a kind of unquantified liability that maybe takes some shine off those liquidity ratios? This is heavy manufacturing, and that often comes with recurring issues. I mean, there was the settlement just last year related to that 2020 fire at their Guaymas plant that caused major disruption. And that wasn't, a one-off incident. There are past regulatory violations, hazardous waste, air pollution. Go back further, there was that lawsuit in 2005 over allegedly defective parts supplied to Boeing. These things taken together suggest an ongoing exposure to operational mishaps, environmental compliance issues, things that could suddenly hit the bottom line and impact future profits. It raises the bar even higher for that perfect execution you need to justify the price.
Well, look, past operational issues definitely need careful management. Absolutely. But I'd argue the market has largely factored these known risks into its assessment of the current management team. The fact that the stock performed so well, even as some of these issues were being resolved, suggests investors trust this leadership to navigate these kinds of challenges, which, let's be honest, are pretty standard for complex manufacturing operations. These are historical incidents, some quite old. We need to focus on the present. The stability provided by that high institutional backing and their financial discipline. The low debt means they actually have the capacity to handle unexpected operational costs without jeopardizing the business or needing to dilute shareholders.
Let's also consider what some insiders are doing. Despite this narrative of strong confidence, we've seen planned or proposed stock sales by company officers, and even the trust associated with a former board member, Robert C. Ducommun, scheduled for 2024 and 2025. Now, when insiders, people who know the company best, plan to sell down their stakes, especially when the stock is near its highs, well, it does suggest that maybe they see the current price as a good time to take some profits. That seems somewhat at odds with the idea that flawless multi-year execution is a given, doesn't it?
Look, I stand by my view that Ducommun is fundamentally a high-quality, resilient company right now. The premium valuation, I believe, is earned. It's justified by the successful strategic shift, by management proving they can expand margins, and by those strong defense tailwinds providing a solid foundation. Their ability to navigate the commercial weakness, as we discussed, isn't a red flag. It's actually a sign of strong operational management. They're steering the ship effectively. The market is pricing in the continued success of Vision 2027, and that robust balance sheet gives them the platform to achieve it.
And while I acknowledge the current strength, that trailing PE of 34.51 and, critically, the PEG ratio over 2, they just reflect market expectations that are, frankly, incredibly demanding. There's very little margin for error, whether it's operational slips, integration issues with acquisitions, or just a cyclical dip in defense spending. The long-term story for Ducommun really hinges entirely on them executing that Vision 2027 plan almost perfectly, integrating new strategies like aftermarket services smoothly, and continuously managing those historical and likely recurring operational and environmental risks. If that defense tailwind eases up, those segment imbalances we talked about, particularly the commercial aerospace weakness, could become a much bigger problem very quickly.